Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Wingstop.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine you're running a business where, fewer people are actually walking through your doors every single month.
Yeah, foot traffic is actively shrinking.
Right, foot traffic drops, yet somehow your profits just skyrocket by more than 60%.
Yeah.
I mean, it completely breaks the fundamental rules of retail.
It really does. You'd think a company pulling off that kind of financial magic would just be the absolute darling of Wall Street right now.
Exactly. But that is exactly what they just pulled off, and the market is completely punishing them for it. The stock is hovering right near its 52-week lows.
Which is wild when you look at the actual numbers.
It is. So our goal for you today is to unpack this massive disconnect. We need to figure out if Wall Street is just completely mispricing an absolute cash machine.
Right, because when you see fundamentals moving aggressively in one direction and the stock price moving aggressively in the exact opposite direction, that's usually where the most compelling opportunities hide.
So the big question for your portfolio today is this. Does this represent a rare, multi-year compounding entry point below that $210 mark?
Or does the broader market know something that the income statement just isn't showing us yet?
Exactly. And to figure that out, we really have to look at the mechanics of how they actually make their money. Let's start with the financials, because fiscal year 2025 was just a monster by any metric.
Oh, absolutely. I mean, the top line numbers alone are pretty staggering.
Right. Total revenue hit $696.9 million, which is an 11.4% jump.
Yeah, and if you look at their system-wide sales, meaning the total amount of money spent by consumers across every single location, that figure actually reached $5.3 billion.
$5.3 billion. That is a massive volume of sales.
It is, but honestly, the real story here is the profitability attached to that volume. They aren't just, selling more food. They're keeping significantly more of every dollar that comes through the door.
Because their margins are expanding, right?
Exactly. Their net margins expanded to a massive 25.5%.
Wow.
Yeah, in the restaurant business, operating with a margin profile like that is almost unheard of. It requires an incredibly high level of operational efficiency.
And pricing power, I imagine.
Exactly. That specific margin expansion is the mechanism driving their bottom line. It's the reason their net income surged 60.3% to hit $174.3 million.
So they're functioning less like a traditional restaurant, more like, a highly optimized toll collector on that $5.3 billion.
That's a great way to put it.
Okay, but I'm glad you brought up how they function, because here's where the puzzle really comes into play.
Okay, let's hear it.
Well, you hear those numbers, right? Revenue up double digits, margins sitting at 25.5%, net income up 60%. You would naturally think the underlying consumer demand must be completely flawless.
You would.
But there's a glaring red flag in the fourth quarter data. Their domestic same-store sales actually declined by 5.8%.
They did.
Let me just stop right there and push back on this, because if same-store sales drop nearly 6%, that explicitly means fewer people are walking into their existing mature locations.
Yes, foot traffic at the older spots is definitely down.
So how on earth did their total revenue jump nearly 9% in the fourth quarter to hit $175.7 million? The math feels totally contradictory.
It does feel contradictory until you look at the magic trick of their specific growth strategy.
Okay, what's the trick?
Relentless, aggressive unit expansion. Think about it. If you're selling slightly fewer items at the stores you've operated for years, the only way to forcefully grow your top-line revenue is to just drastically increase the sheer number of cash registers you operate.
Oh, I see.
And they did exactly that. Last year, they opened a record 493 net new stores.
Wait, almost 500 new locations in a single 12-month window.
Yeah, that is an enormous physical rollout. It represents a 19.2% growth rate in their physical footprint in just 1 year.
Which brings their total store count to, what, almost 3,000?
2,932 restaurants, exactly. So when you look at the macro picture, the fresh revenue generated by those nearly 500 brand new locations is entirely masking the traffic softness happening at the older ones.
Right, because the initial surge of customers at a grand opening, plus all those new geographic markets, it just pushes the total system revenue higher.
Exactly. The system grows, masking that localized 5.8% pullback.
Okay, I see how that works mathematically on a spreadsheet.
Yeah.
But it immediately raises a huge behavioral question for me.
What's that?
Well, if I'm a franchisee looking to deploy capital, right?
Yeah.
and I see that foot traffic at existing locations is dipping by almost 6%. Why am I eagerly signing up to build more locations? Why are independent operators willing to fund the construction of almost 500 new stores when consumer foot traffic is actually shrinking?
It's a great question, and it all comes down to the underlying unit economics of their specific franchise model.
Yeah.
It basically acts as a massive competitive moat.
How so?
Well, they operate a highly optimized asset-light system. Think about the physical layout of a traditional sit-down restaurant or even a fast food burger chain.
Right, you've got massive walk-in freezers, complex prep stations, grills,
Exactly, and a huge real estate footprint just for the dining room. Wingstop is the exact opposite.
because the menu's so simple.
Right. It's heavily focused on premium bone-in wings. The physical kitchen is essentially just a staging area and a bank of fryers.
Ah, okay. So because the operational complexity is so low, your upfront build-out cost is lower.
Lower build-out, smaller real estate footprint, and most importantly, the labor requirements are drastically reduced.
Which means the breaking point for a franchisee is fundamentally lower than it would be with a more complex concept.
Exactly. And the cash generation at the unit level really backs that up. The domestic average unit volume is sitting at a stellar $2.0 million.
Wow. So even with a nearly 6% dip in foot traffic,
Yeah.
a single simplified location is still pulling in $2 million a year on average.
Yeah. And when a franchise sees an average unit volume of $2 million on a low overhead menu, the profit at the unit level remains incredibly attractive.
So that high return on investment creates incredibly high switching costs.
Precisely. Once an operator is inside their system, generating strong cash flow with a really simple operation, they have zero incentive to leave and try running a complex taco or burger franchise.
They're just incentivized to keep taking their profits and reinvesting them into opening more locations.
Right. But there's another layer to this moat that makes the unit economics work so well, and it's their digital dominance. Right now, 73.2% of all their system-wide sales are completely digital.
Whenever I hear that 73% number, I really just stop thinking of them as a traditional restaurant entirely.
What do you mean?
Well, think about how a physical toll booth works. Once the infrastructure is built, the cost of letting one more car pass through is practically zero, right? It's pure profit.
Right. The fixed costs are already covered.
Exactly. Wingstop operates the exact same way, but the app is the toll booth. With almost 3/4 of your sales happening on a phone screen or a computer, you aren't really running a dining room.
No, not at all.
You are essentially running highly profitable, localized cloud kitchens that just happen to have a storefront attached.
I love that analogy.
Right. Because once that digital infrastructure is in place, capturing an extra digital order doesn't require a waiter, a physical menu, or a cashier. The customer taps their phone, a ticket automatically prints in the kitchen, the food goes in a bag, and a delivery driver grabs it.
That digital toll booth analogy captures the mechanism perfectly. And if we connect that mechanism to the bigger picture, that massive digital scale translates directly into customer loyalty and data retention.
Which is huge.
It is. Before this recent traffic dip, they had a 21-year track record of uninterrupted same-store sales growth. That kind of entrenched digital ecosystem protects them from multiple angles.
Right. It defends their market share against highly diversified competitors like Chipotle.
Exactly, who have recovered strongly post-crisis and are constantly fighting for those same premium, fast casual dollars.
It also has to be a massive barrier to entry for newer players. You see these emerging chicken chains like Lane's trying to expand nationally right now to grab a piece of the market.
Yeah, they are.
But a new competitor can easily lease a building and install a bank of fryers. They cannot easily replicate a digital infrastructure and an app ecosystem that seamlessly processes over 73% of a $5.3 billion system.
Precisely. The fryers are easy to copy. The digital toll booth processing billions of dollars is not. So
Yeah.
you have this combination of an asset-light model, massive digital integration, and aggressive unit expansion.
And that specific combination generates a tremendous amount of free cash flow for the corporate entity.
Exact.
But having cash in the bank doesn't automatically make you, the investor, wealthy. It really all comes down to capital allocation.
Right. What is management actually doing with all this money?
Exactly. And what does that behavior signal to you as an investor evaluating the stock?
Well, management is taking that massive free cash flow and basically using it as a weapon to aggressively shrink the supply of their own stock.
Through buybacks.
Yeah, they are returning capital to shareholders through a massive share repurchase program. Since August 2023, they have invested nearly $700 million into buying back their own equity.
That is a lot of capital.
It is. They've retired 2.6 million shares from the open market. And to put that in perspective, 1.2 million of those shares were repurchased in 2025 alone.
Shrinking the float like that is such a powerful mechanical advantage. If you think of the company's total earnings as a pizza, reducing the number of outstanding shares means every remaining investor suddenly owns a larger slice.
Exactly.
Even if the underlying net income stays exactly flat, the earnings per share automatically goes up because there are fewer shares claiming a piece of the pie.
And they aren't stopping there. The brand new catalyst that just hit the wire is a fresh $300 million buyback authorization.
Oh, wow. When did that kick in?
It became effective on March 11th, 2026.
That is the exact mechanism driving shareholder value here. They are forcing earnings per share higher by systematically retiring the float.
Yes, they are.
Okay, I hear you on the aggressive buybacks and the cash flow, but I really need to push back here.
Okay, go for it.
Let's look at the rest of the capital structure and the insider flow, because there are a couple of things that might make an investor severely hesitate.
What do you see?
First, a company director recently sold 2,700 shares. Second, and honestly much more importantly on the balance sheet side, they took on a $500 million securitized financing deal in December 2024.
Yes, they did.
Taking on $500 million in new debt in a high interest rate environment feels like a heavy anchor. If foot traffic drops another 5% next quarter, does that debt suddenly become a chokehold on their ability to support the franchisees?
That is exactly the right level of skepticism to have. But we really have to unpack the mechanics of that specific debt and the scale of the insider selling.
Okay, let's hear it. Address the insider sale first.
Sure. Yes, a director sold 2,700 shares. But you always have to look at insider selling relative to the corporate buying. People sell shares for all sorts of personal reasons, right? Buying real estate, tax obligations, simple portfolio diversification.
Right, it doesn't automatically mean the sky is falling.
Exactly. When you compare one individual selling 2,700 shares against the corporate entity itself buying back 1.2 million shares last year, the directional signal from the board is overwhelmingly bullish. The company is actively consuming its own equity at a massive scale.
Okay, fair enough. The insider sale is pretty negligible in context, but walk me through the debt. How does a $500 million anchor not drag down their flexibility?
Because of the nature of the debt and the strength of their margins, this wasn't just a standard corporate loan, it was a securitized financing deal.
Meaning what practically?
They essentially took the highly predictable, guaranteed future royalty streams they know they're going to collect from those thousands of franchise locations, and they packaged that income stream to use as collateral.
Ah, okay. That changes the risk profile entirely.
It does. Furthermore, this debt load is entirely mitigated by those 25.5% net margins we discussed earlier.
You can say they're throwing off so much cash.
Yes. Exactly. Their free cash flow generation is so robust that their interest coverage ratio, meaning their ability to easily pay the interest on that debt from operating profits, it remains incredibly healthy.
So they are generating so much cash from the franchisees that paying the interest on $500 million barely dents their operations.
Correct. They are even taking a portion of that capital and placing it in investments that yield interest income, which further offsets the cost of the debt.
That's pretty smart.
Yeah. When you look at the whole picture, the board is staring at the debt obligations, looking at the cash flow, and confidently authorizing a new $300 million buyback.
Because they know they can afford it.
Exactly. That authorization acts as a de facto institutional support floor. They are signaling to the market that they have so much excess capital, the absolute best return on investment is buying their own stock.
Okay, but this brings us back to the core mystery. If the buyback floor is that strong and the free cash flow is secured by securitized franchise royalties, why is the stock at $208.66 as of March 11, 2026? It's flirting with its 52-week lows around $204.
Yeah, it's taken a hit.
Right. If the internal engine is running perfectly, why is the market punishing the valuation?
Because the struggle right now has very little to do with the internal mechanics of selling chicken wings and everything to do with external macroeconomic pressures.
The macro storm.
Exactly. The broader market is facing severe headwinds, primarily driven by the energy sector. Oil has surged past $100 per barrel.
And when oil spikes past $100, you feel it immediately in your daily life.
You really do.
If you are a consumer paying over $100 to fill up your gas tank on a Tuesday afternoon, your psychology fundamentally changes. You start looking at your bank app, figuring out where you can trim the fat from your weekly budget.
Exactly. Discretionary spending gets cut first.
Right. In that environment, pulling out your phone to order a highly priced premium combo bone-in wings suddenly feels like a luxury you can easily skip. And that connects perfectly back to that 5.8% drop in foot traffic at the mature locations. It's not that the consumer suddenly hates the product, it's that the consumer's wallet is getting squeezed directly at the fuel pump.
Forcing them to trade down to cheaper dining options or just eat at home.
Exactly.
You've hit on the exact dynamic driving the stock price down. Cost inflation and consumer spending fears are dragging down the broader market, and it is pulling the specific stock down right along with it.
So the market is actively digesting these macro fears and basically repricing the entire consumer discretionary sector.
Precisely. What is notable about the sentiment data surrounding the stock right now, though, is that it's completely neutral.
Neutral, not bearish.
Neutral, we aren't seeing panicked, high-volume dumping of the shares. We're just seeing elevated volatility as institutional algorithms adjust their risk models based on oil prices.
But there's a silver lining hidden in the analyst projections that points to a recovery timeline, right?
Yeah. Yes, there is. While the broader market is stressing about the present moment, some analysts are actually looking through the valley of this macro storm.
Who's looking ahead?
Well, TD Cowen recently upgraded their 2026 same-store sales forecast for the company.
Oh, wow. What did they change it to?
They moved it from a negative 0.5% projection up to a positive 0.5% growth projection.
Okay, which means they believe the 5.8% traffic drop we saw in the fourth quarter is actually the bottom of the cycle.
Exactly.
They think the localized foot traffic is going to stabilize and turn positive as we move through this year.
Yes. So if you are holding this stock, you aren't waiting for people to magically decide to eat more chicken. You are actually waiting for the macro data on inflation and oil to cool off.
That is exactly the right perspective, and it raises a crucial point about valuation for the retail investor listening to this.
Right.
All of this macro noise, the oil spike, the inflation fears, the temporary traffic drop, it's all arguably completely priced into this severe pullback down to the $208 level.
It's totally baked in.
So if we see rate stabilization happen at the macro level, and if oil pressures begin to ease below that $100 mark, the consumer's discretionary income returns almost instantly.
And when that happens, we will see a massive sector rotation. Institutional capital will flow aggressively back into consumer stocks.
And it will heavily favor high-margin franchisors over the traditional heavy-footprint dine-in peers who, struggle with massive labor and real estate costs.
Absolutely.
Okay, bringing this all together for you, what is the core wealth-building takeaway you need to remember from today's breakdown?
Let's lay it out.
Based on the mechanics we've unpacked today, this setup earns a bullish 8 out of 10 score.
Which is incredibly strong given the macro environment.
Very strong. Here is the elevator pitch for your portfolio. The aggressive pullbacks caused by external macroeconomic noise have created a really compelling entry point below $210.
Right.
You have a company projecting 15 to 16% global unit growth for 2026. You have a fresh $300 million in buybacks that will mechanically enhance earnings per share by stripping shares out of the float.
And you have industry-leading net margins sitting at 25.5%.
Exactly. When you combine the asset-light franchise model with that digital toll booth infrastructure we talked about, this looks significantly less like a quick momentum trade and much more like a multi-year hold.
It really does. It allows you to ride that aggressive 2026 unit ramp as they march past 3,000 global stores.
Because the underlying business fundamentals are incredibly intact.
They are. The capital return program is highly aggressive, and the macro headwinds dragging the stock down appear to be fully priced in at current levels.
Creating a really asymmetrical risk-to-reward profile for the patient investor.
Exactly right.
Well, before we wrap up today, I want to leave you with a final thought to chew on. Something that shifts how you might evaluate your entire portfolio tomorrow morning.
I love these. What do you have?
We noted earlier that over 73% of their system-wide sales are entirely digital.
Right.
If a business pulls nearly 3/4 of its revenue from an app, an algorithm, and a digital data ecosystem, at what point do we stop comparing it to traditional failed companies?
Oh, that's a fascinating way to look at it.
Maybe we should be valuing it like a highly scalable software platform that just happens to distribute its physical product in a cardboard box.
A tech platform that sells chicken.
Exactly. Look at your own holdings tonight. How many of the legacy businesses in your portfolio are secretly transforming into digital toll booths right under Wall Street's nose, just waiting for the market to realize what they actually are?